Ben Nye, the finance guy.
Okay, this is Mortgage Mario. I'm with Ben Nye, the finance guy. He's one of my really good friends. I play tennis with him. How are you doing this afternoon, Ben?
I'm doing great, Mario. It's great to be with you.
Yeah, it's awesome to have you here. Thanks for being on my show. It's a great honor to have you here. And so Ben is a financial expert, so he knows everything when it comes down to the financial realm. And if I ever have any questions, I use him as a resource in his expertise to kind of just be able to know what direction I need to take my clients as far as anything having to do with the financial industry. So Ben, you are working on attaining your master's of finance, and you are a senior financial analyst for Norwell Capital. Is that all correct?
Yeah, I have a MBA from Emory, and then I have CFA designation, which is Chartered Financial Analyst, and I have FRM, Financial Risk Manager, but no one knows about that one. So
Yeah,
we don't usually talk about that.
yeah, and a big difference too, because there are a lot of financial advisors out there and maybe financial planners, but you have the highest level of the certifications when it comes to the financial realm. Because I know a lot of people that are maybe like a financial planner, you obviously kind of gone above and beyond with your certification. So, and I think a lot of people in the general public don't understand the difference between those two. So, but I'm correct in that regard as well?
Yeah, I think that the whole financial industry is so broad.
Yeah.
So what I typically do in the day to day is analyze economic trends. I analyze individual companies. I do a lot of analysis on individual companies, fixed income instruments, and that sort of thing. So and then also providing financial advice as well. So we definitely do have a financial planning department, but I don't do as much on the financial planning side itself. And definitely not recommending mutual funds or anything like that. And just as a disclosure, nothing on
What about
this.
Bitcoin? Do you recommend Bitcoin? Like I just put everything in Dogecoin. Is that a good idea?
On this call, nothing will be investment advice. So I fully absolve myself of any liability. For the record, though, skin in
Yeah,
the
just by
game.
the way, yeah. This is all for educational purposes, everyone. So anything we say can't be held against us in court. Okay, there you go. Go on. I just want to cover my butt.
For the record, as far as cryptocurrencies go, I do not. I think a lot of times it's the best way of going about and seeing what someone really actually likes or doesn't like is what do they own or what they don't own. And I do not own Bitcoin, and I don't own Dogecoin for that matter either. So,
But some famous actors own Bitcoin. Who is it? That's Elon Musk is big into. Is it Dogecoin? He's into
he's big
that.
into Dogecoin.
He has a lot of money, isn't it? I mean, if he's doing it, then I should do it, right?
He certainly has more money than me, and he's done a lot better on crypto than me. So
Yeah.
credit to him for that.
Yeah. But anyway, so I love the videos. I can actually post a link in my video for you, Ben, on, if someone wants more of an extensive high level of the state of the economy, because I've seen those videos that you do, and I love them. And you do them at such a very just high level, and they're honestly just where I gather a lot of my information when it comes to the state of the economy comes from your videos. So, and I prefer to be more of a video person. So I'll post a link to that. But on this video, I just kind of want you to hit some key highlights and some cliff notes on the state of the economy. So some biggies, including mortgage rates, since I am a mortgage loan officer, and rates is always a daily discussion with all of my potential clients and current clients.
Yeah, definitely. I think we'll finish off with that. Save the best for last.
Yeah.
But as far as the state of the economy goes, I think the three things that you got to keep in mind constantly right now is COVID still kind of driving the bus, at least the residual impacts of COVID. There's been a lot of talk about long COVID in terms of people's health. And I think that we have long COVID in the economy. And so let me explain a little bit what that means. First of all, we all know that we had another wave of COVID this summer. What I don't think a lot of people really appreciated is the impact COVID had on especially Southeast Asia and China in the third quarter. And so what you ended up seeing was because you couldn't really get anything out of China, a lot of the factories were closed. In fact, the factories in Vietnam were closed for 10 weeks. That's where Nike produces all of its shoes. It's pretty tough to get your supply and get sales when the place where all your shoes are produced is effectively shut for the vast majority of the quarter. So GDP came in at just 2% in the third quarter. That's not the GDP number that you want in a recovery. You want, the numbers in the 4, 5, 6, 7% range. And those were the numbers we were getting until the third quarter. But because of the shutdowns, because of the supply chain issues, you just weren't seeing that economic growth as much as you thought you might. In the United States, job growth was fairly weak in August. It was weak again in September. I do think that it'll start to pick up though here in October. What ends up happening is as you move through and as you start to reopen these economies, Vietnam's now open. I was just off a conference call on Under Armour and they said all the factories there are open. China is open again. You're starting to get some production and you're starting to get those containers moving and you're starting to get those ships moving again. And when that starts to fire up, it's going to take some time to digest through the system. But I do think that we almost have a second reopening, except the first time we had the reopening, it was on the demand side of the economy as people started to go into businesses and started to buy stuff again. This reopening is more on the supply side of the economy. That's the stuff we don't really see a lot of. We still have labor issues that we need to get through. You see all these ads. Now the ads are not trying to get people to buy something. They're trying to get people to work for them. And so we're working through that now. And I think as the economies, both domestically and abroad, continue to reopen, I actually think that you could have a little bit of an acceleration in the economy. And I wouldn't be surprised to see economic growth in the fourth quarter hit 5 or 6% again, which would be a really nice acceleration from 2%.
Well, that's good news. That just made me happy.
And I'm not the only one.
Obviously help the real estate market, right? So from my perspective, I mean, people are going to be making money. They're going to want to buy homes. They're going to want to stop, renting, obviously. And so from the real estate perspective, that's going to be very beneficial, right?
I think you're exactly right. I think you're already starting to see bottoming out. Redfin actually pushes some great data out every week in terms of pending sales versus the prior year, average median selling prices, as well as sale to list price. And we're still above 100% in terms of sale to list price. So on average, homes are selling above list price in the United States. So that's good news if you're a seller, not so great if you're a buyer. But the good thing is you do have relatively low interest rates right now that you can get. And so you can be able to finance a more aggressive purchase price at those low mortgage rates while they last.
And it's kind of like in my opinion right now, people are waiting out to get a better, a quote unquote, better deal on a mortgage. But obviously, when you're buying real estate, you're doing it for the long term. You're not doing it for short-term gain. It's like when you sit down with your financial advisor and you want all these big returns in the beginning. You're like, look, you're retiring at 59 and a half and you're 25 years old, sir. Kind of similar thing with real estate. We're like, yes, okay, maybe you paid $5,000 over a listing price, but you also have a 2.7% interest rate. Look at this amortized over the course of the loan. You're actually saving a lot more money doing that. And that is deterring a lot of first-time home buyers from executing on a purchase price, transaction. So what's your opinion on that? You kind of agree with me there, or?
Yeah, I agree with you on that. I mean, I'll use an analogy.
Real quick, everyone, I just want to hear, he agreed with me, and this guy's like the smartest finance guy I know. Okay. So I never claimed to be the smartest guy, but I listen to really smart people and he agrees with me. Okay, go on. First time home buyers, just wanting you to know that. Go on, Ben.
So two things. Number one is that the number of stocks where I've had a purchase price and it goes down. I'm waiting for, let's say I'm waiting for it to hit $10 and I'll buy, and it goes down to $10.03 and I don't end up buying it. I've done this too many times. I'm trying to get better at it. And the next thing you know, it's $20 a share. It's like, are those 3 pennies really going to make a difference in the long term? And if you think about it, it's even more so in the home purchase market, especially if if you're buying your first home and you're going to be living in it. Because the fact of the matter is, as the market moves, you're now in you're now in the game. You own a property. So if the market goes up 20%, you're going to end up, and you want to move, you're going to end up having to buy another house that's up 20% too. But at least you're in the game. Versus if you just continue to rent and things go up 20%, not only are you still spending money every month on rent, but now you have to pay something 20% more. So I think that, if you're going to stay in one place for an extended period, buy something you can afford. We're not saying buy something you can't afford, but don't try to
And that's not even an
nickel and
issue these
dime your
days.
way into it.
They're so strict on DTIs. The FHFA that oversees the Fannie Mae and the Freddie Mac secondary markets where lenders borrow money from, they are so strict on the guidelines. So if you connect to a loan officer like me and they say you are approved for this price point, don't worry, you're good to go. It's not like the good old days where they would put their hand on your neck and go, hey Ben, you got a pulse, we're gonna give you a loan. So and I think so many people are scarred from '08, and that's another thing that's preventing first time home buyers from buying a house, because they basically hear all the information from the baby boomers, their fathers and their mother and things like that. That, oh, we got this mortgage and that guy, the loan officer, scammed me or whatever. And don't listen to a word that Mario guy says. He's a liar. And things have evolved, sir, mister, things have changed so drastically. So, if you got to prove that $200,000 condo, like, you are good. You have the DTI for that. But go on, Ben.
The last thing I would say is that when you're looking at rent prices, those are just going to keep going higher. I was looking at rent prices the other day, and they're really raising rent prices fairly aggressively. And so, and it makes sense because their property values have gone up too. So they're going to raise rent on you. So you end up paying for it one way or the other. At least if you own a property, your payment's fixed. I know I bought my home through Affinity Home Lending actually a couple years ago before Mario got there. One of the great comforts that I had when I purchased my home was, I don't know what the home price is going to do. And frankly, I don't care because the market's going to go down or up regardless. And I'll be in the game regardless. But the real comfort I have, I'm not swallowing another 6%, 7% increase in my rent every single year. My payment is fixed for the next 30 years. I have an HOA bill, but apart from that and property taxes, it's not changing.
Yeah, that's awesome. Like I said, it's a slam dunk when you're going to be there in the long term. None of us have a crystal ball, so we can't obviously see the future and know exactly what's going to happen. We can crunch some numbers and we can crunch data and analyze that and try to forecast things, but still nothing is guaranteed in life except for death, taxes, and getting the best mortgage rate for Mario. Those are the three things guaranteed in life. But okay, cool. Well, cool, Ben, go on. Sorry to interrupt.
Oh no, and then the last thing that I had was you asked about mortgage rates. I've been phenomenally bad at forecasting mortgage rates. So
don't say that. I'm going to cut that out of the video.
But here's what I do know is that the Federal Reserve is almost certainly going to be scaling back its asset purchases beginning tomorrow at its meeting. And what that means is they're not going to be buying mortgage-backed securities. So what happens when you lose a buyer of mortgage-backed securities? Well, if you lose demand for something, the price of the price of it begins to fall, which basically means that you'd be paying more money for your mortgage. So if the Federal Reserve starts to slow its purchases of mortgage-backed securities, the rates are more likely to go higher than lower. So I think right now, I think it's a fairly opportunistic time to be making a purchase, to be refinancing. It's just historically cheap money. And with the economy accelerating, in my view, I think that rates are more likely to go up than they are to go down. So that'll be my view on mortgage rates. But again, take it for what it's worth.
Yep. I appreciate that. So, but ultimately, no one has a crystal ball, in my opinion. And if I see someone that still has PMI, that's private mortgage insurance, and maybe they bought their house 2 or 3 years ago, or maybe they want to drop down, they finally have the debt to income to be able to handle a 15-year refinance, and they've seen the course of loan, you're going to save a lot of interest there. And if you like, at the end of the day, if you see the rate and you like your mortgage payment there, then lock in. Don't sit and worry about the future, because none of us can see the future. So that's a big thing. But there still are good opportunities to capitalize on the refi market. But from a lot of the veterans told me, I know the president and owner of Affinity Home Lending, DJ, when he's been in mortgages, since the Stone Ages, and he says once he starts seeing them kind of going up, then he just sees them, they just shoot up, and then the refis are over. And I know a lot of the veteran financial experts and mortgage loan officers are predicting that we're kind of at the tail end of the refi boom. So if you haven't, then I think you really need to at least look into doing it. So but yeah, I appreciate you being on the show, Ben. You've been a great help. I'm gonna put this on my website and everything, and let it be good content for any of my viewers. So that way, if they're kind of have any questions regarding the financial process, then this will hopefully answer some of their questions.
Awesome, Mario. Thanks for having me on.
All right, have a good one. Bye.